right, guys, welcome to another episode of the Practical Wealth Show. So this show, let's start out with what we're about. This show is Notes Investing for Real Estate Investors. Okay, there's two sides of the real estate business. The real estate side is the paper side, where you can literally be the bank. Okay, so we're going to help you explore the other side. You want cash flow, so you get both. So I have Mr. Jorge Newberry. And George, the company is called preREO,
preREO, exactly.
Okay.
So our people that are familiar with REO properties, it's preREO. We're selling it, selling the notes before they go REO.
Okay. And so he's been in the distressed asset management borrowing, advocacy for like 30 years in this space. He's got a book called Burn Zones. We're going to talk about that. And so George, I'm going to let you tell him a little bit more about yourself, but welcome to the Practical Wealth Show.
Hey, I appreciate you having me on, Curtis.
Yeah, my pleasure. So tell him, I know you've been doing this a while, but tell him what I didn't tell him, and then let's get into how we can help these people make some money.
Sure. Yeah. So preREO is a platform where institutions can sell defaulted non-performing mortgages at discounts to real estate investors. And many people hear about this, but it's usually the sales go from institutions to institutions.
Mm-hmm.
And there's a lot of reasons for that. And so we've tried to address those issues and make it easy for a institution to sell to a real estate investor, sell one loan to a real estate investor, which has been unheard of. You're not going to have, we have Goldman Sachs backed hedge funds who are now selling loans on a one-off basis to real estate investors. And that they always wanted to do it. And why would they want to do it? Why not just sell it to other institutions like they've always done? Well, that's what they've always done. But those institutions always price in, well, what if this goes REO? We have to pay a broker. We have to pay all this. So they're usually priced down a little bit. A local real estate investor who's maybe buying a mortgage that's a defaulted mortgage that's secured by a home in a market where they live or they operate is usually going to be willing to pay an extra 5 or 10%. And it's still a massive discount typically than what they would buy it if it went REO. And so that's the solution. That's the problem that we tried to solve. And we went to these institutions in our infancy and said, well, this is what we want to do. How can we do it? And I'll tell you that they're saying, hey, well, we're selling 100 loans, and you're telling me you have 100 different buyers, and I have to do a different contract for each of them. I have to do a different know your customer check for each of them. They say, forget the extra 5 or 10%. I'm just going to keep selling it to institutions. So it's an absolute non-starter. So what we did is we said, well, we need to make this look like they're selling it to another institution. So we set up a trust, preREO trust, and US Bank is the trustee. And we said, okay, all the loans will be sold into this one trust. And then that trust will give participation agreements to each of the investors who, as to the asset or assets that they acquire. So, Curtis buys 3 loans, then there may be 1,000 loans in the trust, but you have a participation interest in those particular 3 loans. So it's basically entitles you to all the monetary benefits or gains or losses from that particular asset. And you make the decisions, you get delegated authority, make decisions on these loans. And that's been something that has resonated. Now the sellers may be selling 100 loans, and they may know they're going to 100 different buyers, but to them, there's one contract, one buyer.
Right.
The buyer is a trust with US Bank as a trustee. So check.
You're giving, because what happened was, here's how I heard it, George, before, was you got to get in with asset managers. You have to buy tranches of, look at them. You got to figure out what you want to buy. You want to do performing, not, it was like a whole thing. Yeah. You had to be, network your way into where you could get on the list where people would find these. And it seemed great, but it seemed like a lot of work, luck, and whatever, right?
It's a really opaque industry. You can't, if you're selling a home, the same funds, if they sell a home, that home's probably going to be listed with a local real estate agent. It's going to be on the MLS. It's going to be on Zillow. And that is, so they get broadly marketed. But when it's a note, historically, none of that has happened. There's not, and you hear about tranches and whatnot. Tranches they talked about in securities where they would sell different tranches.
Yeah.
So we're selling the actual whole loans, the whole mortgage. So somebody is buying an interest in one particular mortgage, and once they acquire it, they control that one mortgage. So it's not tranches, and there's no asset managers to kind of convince, and they
Right.
don't, to convince an asset manager to sell you one loan, they just don't have the time or bandwidth to do
Right.
it.
You got to buy a bunch, and then you
Gotta
got
buy
to,
a bunch.
so I'm gonna keep it basic. So tell them what first, performing, non-performing, define that.
Right now, sir, so performing is a loan that's paying on time, and is typically current on their payments. So that is a performing mortgage. There's also reperforming, which means they fell behind at one point. It's now been modified, and now it's reperforming. And typically after 6 or 12 months of on-time payments, there's a healthy market for people to buy those, because it demonstrates, okay, they're going to start paying again. And then there's non-performing, and these loans are typically in foreclosure or eligible to be referred to foreclosure because they are typically not paying.
Okay.
So those are primarily the three kind of buckets of loans. And the non-performing present the most challenges, but also present the greatest opportunities. They're typically sold at the biggest discounts. And, and this will vary with the market. I mean, today it's still a healthy market. Obviously there's been some turbulence in the economy over the last 60, 90 days, which is making everything a little bit, the footing seems a little less sure than it was in the months before that and last year. But the market was on fire. Just like the real estate market, the note market was absolutely on fire for a couple of years post-COVID. And that has tampered down a bit with the increase in interest rates and, people uncertain about where real estate's going. But it's still strong. So today, if there's let's say a mortgage of $220,000 is what they owe. The home value is $200,000, so it's still underwater. And that will probably sell for around $150,000. So a $50,000, 25% discount off the property value. That's very common. And they actually, that's usually what they're listed at. So these are listed, and then people can make offers. And in reality, historically, things have been selling in the low 70s, like 72, 73% of property value. There's also instances where people owe 150 and the property's worth 200. With all the appreciation that's happened over the last few years, a lot of people have equity. And in those cases, they're typically sold at 90% of the 150. So they sell for around 135. Why is that? Well, there's a high likelihood that a homeowner, they get into trouble, foreclosure starts, there's real estate agents and investors knocking on the door, hey, I'll buy your house. And when they buy it, they pay off the mortgage in full. So if someone bought it on preREO and paid 135, there's a chance they may get paid off next month at 150 plus whatever interest has accrued since their acquisition. So you'll see both of those, but non-performing is definitely where the big discounts are. Performing, the discounts, usually it's not so much a discount. There can be discounts, but many times you're simply buying, hey, these people are paying, they're paying a 7% interest rate. That's the return that I want. So I'm going to buy this mortgage where it's paying at 7. There's some instances right now with the low interest rates that happened over the last couple of years, the 3 and 4% rates, that people are having to discount those because people are saying, well, no, I need a 6% return. And there's all the coupons only 3 or 4%. So they are discounting in those situations. So you'll see those. And right now we primarily offer non-performing, but we have seen, for instance, there's a fund that's putting on 800 loans next month. They're all performing, so all up to date on their payments, but there is a big caveat to that. They all have compliance issues. These loans are originated by City Financial and Associates Financial 15, 20, 25 years ago. And they have some compliance issues, missing documentation, things like that. So they can't sell them to institutions. So here they are. Hey, what's an outlet? People are going to probably buy these and put them in their IRA and stuff like that, and in their IRA and different, who knows, maybe in some of your whole life clients need paying notes. Right. And these were written years ago when rates are like 9, 10, 11%. Today that seems, oh, that's a great return, because it is a good return, especially compared to what.
And you're buying it at a discount. See, so I want to go back to another question, but so one of the things that we're doing, guys, I'm going to put a link in here, and I'm going to send you a video called the 5 Principles of Personal Finance. So where this opportunity for this generate this returns and this cash flow is principle 4, which is liquidity, right? And so what we teach, George, is to capitalize. See, most people want to invest, which is forfeit, control, to generate income or cash flow through capital gains or cash flow,
Mm-hmm.
and eventually have to liquidate it, right? What I want people to do and what we're teaching is to capitalize. So I want you to accumulate financial value in order to leverage that value to acquire wealth without
Mm-hmm.
having to liquidate the asset to get the other asset. Okay. That's where infinite banking comes in. All right.
Mm-hmm.
But you got to, how do you do that? Well, you got to save some money. Okay. Or you got to have some capital so that you can do this. So Curtis, I got $200 a month. Well, no, this is not for you yet. You're not ready. You got to go start a business and make some money. But so I want to show them. So you got, see, one of the things, guys, y'all, a lot of you are listening, have some capital. And so what I try to do with this show is give you information so you can research what George is talking about. So you know, I have a client I was just having read The Richest Man in Babylon, right? So I say, look, here's what we're going to talk about this morning. Start thy purse to fattening, right? Pay yourself first, where I don't care what you're making, right? Budget thy expenses. That's all we talked about. But see, make thy goal multiply. Principle 3 is this, right? I've got some money that I've saved because I paid myself first. Now let me put my money to work. So I want y'all to position where these things come from. All right. So now back to our regularly scheduled broadcast. I want to do that.
That makes a lot of sense.
Yeah. So I want to show them how to position and how you use this stuff, because everybody thinks the key is investing. Well, if I teach there are 5 things, investing is number 5. Okay. It's not the first thing you start to look for, because there's more opportunity, George, in minimizing the losses in your life than there's trying to pick the winner. So what we teach is efficiency, right? And building, capitalizing, so that now, you know, when you make money, your taxes are minimized. You've got a safe place for the money. You don't have holes in your bucket. You're always chasing returns. Okay. Now I want to go back. I want to come back to that, but I want to go back for a minute. And because I'm looking at my notes, right? So the question is, how do you lose 26 million in real estate? You can see, to me, I don't like people that haven't had any setback, right? Is how do you respond after that? Is like, I don't, young people that are like on the top of the world, I don't trust them because they haven't failed yet and they think they're Superman, right? I want people that have had some setbacks and bounced back. So that was almost all of your money. How do you do that and bounce back financially, mentally? Because a lot of times we tie our money to our net worth, to our money. So there's a whole mental thing going on. Let's talk about that for a sec, because I want people to get the lessons of, you know, what birthed this thing. Okay.
Yeah, no problem. Yeah, so failure is my best teacher. I think failure is everybody's best teacher. It's where you learn the most. When you succeed, you think, okay, I'm doing everything right, I don't have to change. When you fail, you have to do things differently. So I'll tell you what happened. I started real estate in 1990. My first real job, I was 25. I got a job as a loan originator in the contact center. I'd answer phones and try to schedule people to meet with a loan officer. And within a couple of years, I became loan officer, branch manager, started my own mortgage company. And then I started buying defaulted real estate. And this was like 92, 93, when there was a downturn, one of the downturns. And I bought a lot of defaulted apartment buildings that were REO. And I was in Los Angeles, Southern California at the time. I bought about, in total, I ended up buying about 500 units in LA.
This is like, you're 27-ish.
Yeah, I was like 27, 28, 29. Yeah, right in that era. And when I was, so I was really excited, high energy, but what I did, and my strategy was to buy the least desirable buildings, the ones that had the most problems, and then I'd be very hands-on, and I'd turn these things around and make them into success stories. And I would buy some just super challenging buildings. And when I did that, I discovered, hey, I could add value, make a lot of money, and that's what I did. And I'll give you an example, because this is an extreme example, like real estate investing extreme. So I bought, when I was 28, I hadn't really thought about my age at the time, but in 1998, I was 28 years old, and I bought a building called the Fort Hotel, which was a 298 unit apartment building in downtown Los Angeles. And I bought it for $650,000, which people are just like, wait, it doesn't compute. That's like, $2,500 a unit. So how does this happen in downtown Los Angeles? Well, here's why. The building had sold about 8 years before for $4 million. And that owner the property was in such terrible condition that owner was put in jail for slum violations at the property. So he sold it to the next owner for $2.5 million. Now he ended up in jail. So he sold it to the guy I bought it from for $2 million. And this guy ended up in jail. So at this point, everyone's saying, okay, if you, it's not
Talk about extreme examples, right?
Yeah, it's not difficult to do the kind of compute. You buy this building, there's a good chance you're going to end up in jail.
That's funny.
So of course, me being like ever the optimist, I said, no, I can do this. I can succeed where everyone else failed. So that was me. And so I bought it, and I bought it for $650,000, just unbelievable, for 298 units. And this was broadly marketed. It wasn't a secret deal. It was broadly marketed, and no one was, I'm not buying it. And so I bought it, and I before I bought it, I met with some of the inspectors, and they said, do not buy this place. We're going to end up adversarial. You've done these smaller projects. You've had success. You've done good work, but this is not going to work. And I'm saying, no, it's going to work. So after I bought it, they all met with me. I met with all the city inspectors on the slum housing task force. And they said, okay, you got 6 months. We can't selectively prosecute. We put everyone else in jail. If you can't get this done in 6 months, we have no choice. We can't selectively prosecute. So I sat around working, and I was there every day. And the inspectors would come by more or less once a month, and they would come by and they say, you're making great progress, great work, Now, on New Year's Eve of that year, this is 1998, a friend of mine called me and said, hey, you're in the paper. And I said, why? He said, 34 criminal charges filed against Fernando each man. So I was like, I was petrified. It was 6 months later, but no one had told me that the result that this was about to happen. I presume because I had made good progress that the city was going to be accommodating. And so that was an extremely stressful moment in my life. And the first thing I thought about was my parents, because I lived about 10 minutes from my parents. And I said, my mom's going to be sitting down to her morning cup of tea, and she is going to pull out the Los Angeles Times and read about her son, all these criminal charges against her son. So I got in my car, drove over to my parents, grabbed the Metro section out of the LA Times, and headed out the door and said goodbye to my parents. I did not tell them what I was going through until after it was all done. Okay. Now I talked to my my attorney, and he called the city attorney, and the city attorney said, hey, we agree he's been making good progress, but we can't selectively prosecute. In the end, though, we agreed to a plea bargain. I agreed to pay a $10,000 fine, and I was on probation for 6 months. For 3 years. And basically, when they said probation, I said, oh man, I guess to go to like a probation office every week or something. And he said, no, it was summary probation, which is basically the lightest form of probation. And as long as I didn't get into trouble, and I continued to make good progress on this building, then I would not go to jail. And so 11 months later, and this is my optimism, I thought I could get it done in six months. It took 17 months, but 11 months later, a total of 17 months since I bought it, the slum housing task force, all those inspectors came in, and they could not find a single violation in the whole property, even though it was occupied. So that was the day they signed off, and I promptly sold it, made over $1 million. And I was like, it was a good and bad situation. I was emboldened. I was thinking, I could take on anything that everyone else has failed at, and I will succeed. So then I set off across the country, buying the country's toughest projects, and turning them around and making good money. I bought a property in Kansas City. That was my first big out-of-state acquisition, 233 units, downtown Kansas City, 8 murders there the prior year. And I bought it for $1.6 million. By the time I was done with the rehab, I put about $1 million-ish into it. Wells Fargo appraised it for, I think, $8 million. They gave me a $5 million loan, and I was like, okay, this is great. Let me just keep doing this. So that's what I did. Now, I did eventually, success came to an end at some point, but I bought. But I was continuing to be emboldened. So I bought 1,100 units in Columbus, Ohio, which was nicknamed Uzi Alley. It was really called Woodland Meadows, but Uzi Alley after the gun, because it was infested with drugs, gangs, prostitutes, and just extraordinarily high crime rate. And I bought that property and I turned it around. By all accounts, a huge success on the turnaround, but it was hit by an ice storm, the largest federally declared disaster in Ohio history, and just devastated our property. And it triggered this extraordinary sequence of events in which I did lose everything and ended up $26 million in debt. And it was humbling. It was, to say the least. I mean, it was shattering at the time. It was to go from success and to absolute financial failure was extremely tough for me to digest. And I'll tell you how I rebuilt, though. I mean, I'll tell you, it was a very difficult time because, you know, I'd always do projects. I had lenders who would give me money. Right now, no one. I was like, I had judgments against me. I had bad credit. I had ended up in a very public battle with the mayor of the city of Columbus, and it's a lot of bad negative headlines. So, and that disaster, that ice storm occurred on Christmas Eve, 2004, and then in 2000, by 2006, I was financially flatlined. In 2007, I started hearing about all, you know, across America, all these families that potentially would be at risk of foreclosure. So I thought, hey, my experience as an overwhelmed debtor could be helpful to them. And I started a nonprofit called American Homeowner Preservation. And families would come to us and we would work, advocate on their behalf with their lenders. We had thousands of families come to us, and we weren't able to help the majority of them. And it was because, in our minds, because the mortgage companies and the servicers were unwilling to agree to resolutions that really made good financial sense for the lender as well as the homeowner. And I'll tell you why. What we would see is, because we were in Ohio, and we started this in Cincinnati, Ohio, and we'd see a family that owed, call it $100,000. Everything had collapsed in value wise around this time. So they owed 100. The house was now worth 50, and we would go to the lender with a proposal to modify or some other kind of resolution, and they would they'd go for sometimes 6 months or a year and a half, and then they deny, say, oh, we're not going to do it. And by the way, the sale's next week. So they foreclose on the property worth 50 when the family was there. They evict the family, kick them out. The home would oftentimes be vandalized, copper stripped, and stuff like that. Now it was worth 25 or 30. And I was looking like, this is just like value destruction.
Right.
And what if they had found a way to keep the family in the home? If the home would be worth a lot more. So we transitioned, we became a for-profit, and we started buying defaulted mortgages, which is how I really got into this business in mass. And in the last decade, we bought more than 10,000 mortgages. And that has been the path forward. It's been a successful one because we buy these loans at big discounts. But now there's another downturn coming in all likelihood over the next year or so, if not sooner. And the opportunity will be massive for investors across the country. We're going to buy loans, but there's lots of opportunities for others to buy loans if there was a platform to do it. So that's really the genesis of preREO, is to create that platform. Because when we decided to buy loans, it was not easy. It was very difficult to find a path into kind of get into the club where you actually buy loans regularly.
That's what I'm hearing. Thanks for sharing that, because I think that's just instructive. It's, folks, it's not all bright lights and glamour. Okay. And we even talked about what the mental fortitude you had to have to dig yourself out when you just want to curl up in a fetal position and just hide. Right. But you have to get up and keep fighting, you know? And so that's powerful in of itself. But one of the things I liked is, I want you to expand on this, because you talked about improving, because to me, you make money by creating value in the marketplace, right? And so one of the things that you're doing is how do you improve communities doing this? I think that's really a powerful point, because you want to make money, but if you can do well and do good,
absolutely,
that's a twofer, and that's great.
Yeah, no, agreed. So we focused on low and moderate income communities across the country, and these are the families that were most heavily impacted, primarily because they were most heavily targeted with the subprime mortgages in the in the early 2000s. Disproportionately went to low income families, and then and most of these families have very limited financial safety nets, if
Mhm.
any. A wealthy family, hey, I get in trouble, maybe there's another family member who can help them out. A family with more modest means, they get in trouble, they go to their friends and family. Hey, a lot of times they're in the same boat, and they and so we recognize it as that was a problem. And if you remember, I mean, 10-15 years ago, there were whole neighborhoods where every other home was vacant. People
Mhm.
were leaving because everyone was underwater. And so it was really important for us to keep those families in their homes whenever they wanted that. If they wanted to do it, that was our number one priority. And because of all the turbulence and disruption and value destruction in these neighborhoods, these loans would sell for very big discounts.
Mhm.
And they were and most big Wall Street hedge funds say, hey, give us the higher value loans, because they could make, if they turn around a $500,000 mortgage, they can make 50, 75 grand. They turn around a mortgage secured by a home worth 50, hey, you can make 5, maybe 10 grand, and just not of interest to them. So we would do this, and we would make 5 or 10 grand, but we do it over and over. And that ended up being a model that was super helpful, not just for us in terms of generating a return for our investors, but also keeping families in their homes, and creating these modifications where families could afford the payment. Because we buy these at big discounts, we can now share the discounts with the families, and they could and now we'd modify it to a payment they could afford, reduce their principal as necessary, forgive some of their delinquency. And the best part is, we do these modifications, they're permanent. So we'd often sell these loans after they paid for 6 to 12 months. We could
Right.
sell them at good sized
Right.
premiums,
Right.
sometimes back to the same funds that we're selling them, but now they were performing loans or reperforming loans. And but the people were right sized in terms of what they could afford, and
I
their
love
payments.
this.
Yeah.
When I first heard the concept, this is probably about 10 years ago. I was like, how do you, but I didn't have a bandwidth to, figure it out. So now you've got the how to find them, how to network. Cause I remember I was in this meetup one time. I was like, oh, it's easy. And they were just, it took me, I almost, and I'm not a dumb guy, but it took me, like, they were talking about yields and this and all the little lingo. And it took me a half hour just to figure out what they, like, all right, the yield, what in real estate they would call the cash from cash return. And then the guy broke down an example of how he did it, how he forgave it, and what the ROI on that, how they still helped the family out, but still made a lot of money. And then all the different exit strategies. So, I mean, I think this is worth your study. What don't they know? What are some of the 3 biggest myths that individual investors they have about, what would you say about distressed mortgages?
Well, up until this point, usually I'd have a lot of money to participate. You couldn't buy one loan.
Mhm.
And so that was a problem. And so one is, you don't have to have a huge amount of money. We finance you, so we'll finance 75%. So the investor only needs to come up with 25%. So that is,
Really?
yeah.
So give me, like, so what would a note be? If you can share, like, the average the cost
I
of a
mean,
note.
a lower value note could sell for 20 grand or something like that. It could be sometimes even lower. So let's say it's 20 grand as a purchase price, and then maybe they owe 60, and the home is worth 35. And that would so it's buying it for 20, they would put down 5, we'll finance the 15. So we'll finance 75% of every asset that's transacting on our platform.
Get out of here.
Yeah.
Okay. All right, we're gonna talk after this thing is
That's,
over. And okay. And what that's
and so that's one thing is,
yeah.
hey, I need to have a whole lot of money, and that's
Mhm.
generally true, except now, because you can get in with 5 or 10 grand. Number 2 is, you need to know, like, have special relationships with asset managers. That's another, historically, that's actually true. It's very opaque business. You can call the bank and say, I want to talk to the department that does modifications, short sales, but you say, I want to talk to the department that sells notes. It's like, there's nobody
Right.
there.
Mhm.
And so historically you would need, that would be true, but today it's not true. You just go and create a free Briar account at preREO, and you can start bidding on non-performing mortgages today. So those are 2 myths. The other myth is, and I think those are 2 of the biggest myths.
Mhm.
I try to think of what other people, because there's not that many small investors in this to date, and I think the opportunities are big. I think the only other one is maybe people think there's you can end up with, it's going to cost you money in terms of, you may have to advance property taxes, you may have to advance legal fees. But again, if you buy a home, a mortgage secured by a whatever size home, the
Right.
taxes and insurance stuff like that will be proportionate. So I'm trying to think of another myth to bust, and I can't think of one. But
But those
give
are
me some
two
time.
good ones. I need a lot of
Yeah.
money, and I need connections to get in there. I mean, that's what I thought, right? And I want to do tactical for a second. So I have a lot of investors. I have a lot of that listen to the show, real estate agents, brokers. How could this make them more resilient to the market changes
Oh,
that
yeah.
we think are coming? How would this help them?
Yeah, I've been telling people that, so right now there's a risk that if you buy a property today that's worth $200,000, and by all means it's worth $200,000 today, you buy it for $200,000. Now, if the market goes down, and if it goes down 10%, 20%, that 200 could turn into 180, could turn into 160, and all of a sudden you're buying this house hoping to make a return on it, and all of a sudden there is no return. You're not even preserving your principal, your investment. So with notes, you can do with preREO, you can do a couple things. You could buy the note, which in this case, probably if it's really worth 200 today, the note's probably going to sell for 140, 150 range. So you buy the note at a discount. So you're insulated somewhat from the potential price depreciation. There's got to be. I mean, the markets are cyclical. There's an expansion, contraction with probably all asset classes, but real estate is very sensitive to the overall economy. I think it's way overdue for a downturn. It's question is how severe is it? And then also we run a fund, so we finance everybody on the who buys a note, and they put down 25%. So sticking with that example, if the home is worth 200 and someone buys a note, I'll use easy math, make it 150, then 75% of that is 112,500. So that is 56% of the value of the home is the 112,500 that we finance. Now, where do we get the money to finance? We get it from investors who can invest in our fund. It pays out today. It pays out 7%, but next week it's actually on the 16th. It's supposed to go up to 9%. And because we charge investors 12% when we finance them, so we basically made a bit of the spread. And that is, but they're investing at 56%. So I look at that as probably the most conservative option in terms of as an investment strategy. You're going to be in a fund. You're going to be your money is spread out over all the financings that we do. And if you look back at the market, the Great Depression in the in the 30s, we had it was roughly both the Depression and the Great Recession in 2008, 9, 10, 11. The market dipped about a third. So 32%, 33% range. Here, we're just, you're getting in at 44%, this 44% unprecedented that there'd be that kind of drop in modern history. So it's very insulated. So that's basically, we're selling notes for more of an active investment. And especially if it's not performing, it is active. You make the decisions, you decide what to do. If you're buying a performing note, it becomes more passive, or if you invest in the preREO fund, it's more passive. So
Wow.
that's what we do.
That's and so you hinted at this. I wanted to come back to it. The how to maximize the gains on what may be a coming recession. How does this do that?
Sure. Well, I think people in today's market want to focus on two things. Number one is is capital preservation. How do I not lose my
right? Because not losing is winning.
It's
right.
winning in a downturn. It is
right.
Absolutely true. And the next part is how to make a decent return on that money. And right now I'm talking like the notes are selling for 70 to 75% of property value, but that's only because the market has been so hot for the last several years, and it's pushed the it's made the discounts smaller and smaller, because 6-7 years ago you could buy these things at 50 cents of value. So if it was worth 200, you could buy it at 100. And some nicer higher value properties sometimes would be 120 or something like that, but it's inched up to like 70-75%, sometimes even higher over the last few years. But that's sure to drop as the downturn, we've become entrenched in a downturn. those spreads will widen, and there'll be more and more money to be made on the actual buying of the note. And so that's, and that, if you buy a note, think about this. If you buy a note, let's say now it's worth, the property value is still worth 200, and maybe that same property today is worth 250, but it drops to 200 in a year and a half, and now you're buying the note for 100 or 120. You can see the spread. And why do those property values drop? Number one is there's going to be more supply. There's downturn will generate a lot more defaulted notes. And the other is the buyers. Today, there's still tons of money. Even today, even after there's been some interest rate hikes and stuff like that, there's still a ton of capital sloshing around in our economy that is looking for yield and finding ways to make money, which is still, even with the interest rate hikes, is still keeping
And they don't want
prices.
the volatility of equity markets a lot of times, right?
Absolutely, yeah. So where else can we go?
Yeah, where else can you go? And so money's got to go somewhere.
Mm-hmm.
And one of the things that George, we talk about, that try to hint at every now and then I get into it, is Jim Rohn says economics is major, right?
Mm-hmm.
And so my mentor, who we talk about, the great author of the book Become Your Own Banker by R. Nelson Nash, one of the things in talking to Nelson, he said, listen, if you know what's going on, you'll know what to do. And so I try to give our clients, I want them to I want you all, the listener, right, just think through a macroeconomic lens. You got to kind of see the whole playing field, right? And then you see opportunities. And so what you want to be able to, why do I teach people to save and capitalize? Because you have to be in position to take advantage of them. See, nobody has a working crystal ball. So I work on positioning. I don't tell people what to invest in. I just make sure they're in a position to, if they see something they like, they have capital or access to capital to pull the trigger. That's your job, to make yourself rich. That's not my job. And there's no financial advisors, like a wealth managers. I don't like that term, because they're not definitely don't create wealth, because mutual funds, what's his name? Jack Bogle says you put up 100% of the money, put 100% of the risk to maybe make 30% of the profit. So I don't view that as investing. I view that as speculating. Okay. And so that's one. So it's all about your perspective, and then beginning to, if you call George, I want you to think about, how it works. For example, are they investing for cash flow, capital, a little bit of gain, or both? How does that work? And which way? Like if they buy the individual note, it's really a cash flow play, because every time they pay their mortgage, you get paid.
Exactly right. Every month, typically.
So you're the bet. What about in the fund?
In the fund that we distribute every month, same thing, because the investors who buy a non-performing mortgage and finance it, we still require them to make a monthly payment. So we keep we don't wait until, hey, it's sold, because sometimes they can, or dispose, there's a resolution, which could take 6 months, but also could take a year or two. And then the interest will keep compounding. So we don't. So each month, the investors who buy the notes, if they finance them, they'll pay us a monthly payment, and then we distribute that money to investors each month.
Wow. So let me give you all a case study. So if you're not giving investment advice, but let's say you had money in a self-directed IRA, like this is the stuff I like that for. I don't like buying real estate in a self-directed IRA, because you take a tax. I heard it from Tom Wheelwright. You take a tax favorite vehicle and put it in a tax deferred vehicle, right? But so that's stupid. Okay, let me just be clear. But now a Roth or a self-directed traditional, now you've got money, it's sitting there in the stock market. Well, all right, here's something, 20 grand, he'll finance it. That, you can think about that. Or better yet, borrow against your properly structured dividend paying whole life insurance. Now you don't have to liquidate. You're still making money. Your cash flow pays back your loan, and you can have your cake and eat it too. That's what we do, right? And so that's awesome. So George, tell them as we close, because I know he's working on a deal as he speaks. So I'm glad you took the time to talk to me. Tell them about your company, the book Burn Zones, and so where they can get that kind of stuff, and then tell them where you want to go to find out more about this stuff.
Sure. So go to preREO.com, PREREO.com, and you can learn all about buying defaulted notes, buying performing notes, as well as investing in the preREO fund. And so that's preREO. You can contact me through there as well. I wrote a book called Burn Zones. Let me see if I can show it to you. Maybe it's not going to show. Oh, there it is. it's not going to show that great. But either way, it's burn zones. That's me bike racing when I was in my 20s. That's what I did before embarking on real estate.
Oh, wow.
And
Okay.
yeah, I was in the '88 Olympic trials. So I used all that focus and determination that you learn being a bike racer, applied it to business. But burn zones tells the story. Like I shared a bit of it today about me making a lot of money in real estate, losing it all, and then rebuilding from there, and the lessons learned along the way. So preREO is really a kind of combination of all the failures, successes, things that I've seen work, things that didn't work over my experience, and I've always been, how do you find a better way? And so hopefully preREO, it's still a work in progress. We're still getting ready for that downturn. I tell my team, we want to optimize our capacities. Once this downturn hits, we're ready to really grow. But as I said, we have hundreds of assets on the platform right now. We have hedge funds that are giving us hundreds at a time. So it is something where there's opportunities today, but I'm building this for the next year or two, when I think there'll just be an extraordinary opportunity.
And they don't need to be accredited to do this.
No, our fund is under Regulation A+, so it's accredited and non-accredited,
okay.
and we make it we make it really accessible. $100 minimum investment, pays up to 9%, and it's distributed monthly. So people could put in however much they want. We have people at a few $100s. We have people at over $1 million in our different funds.
Wow. Okay. And think about that. So some of you are listening are my clients. We should talk about this. Okay. And I'll get you on a call. George, I need to have you back on a where you can do we have a membership program, Money for Life plan. So
okay.
I'm gonna do starting to do mastermind calls for our members, and then you can get into a little bit more if you want.
Absolutely.
And,
I'd love to.
Yeah. So I want to do that. And so anything I didn't ask you, you wanted to say, or like a closing words, because I appreciate your time so much. This was awesome.
No, I think a message for everybody out there who, when I had my failure, a lot of people, I was embarrassed. It was like feelings that would go through my mind, just as everyone who lost their house in foreclosure. Feelings of failure, guilt, embarrassment. Where did I go wrong? What could I have done differently? These are all the, what creeps up when you make a mistake. And I realized that. And, but and in those first few years after it was embarrassing whenever someone read about it online or found out it ran my credit or something like that. I was like, oh my God, they discovered something. And then there was a conference that I was at maybe about 10 years ago, and it was a small conference. So suddenly I got pretty comfortable. I started telling people about what happened, about all my failures. So we have like 4 or 5 people on stage, all talking about their successes. And I started talking about my failures. And I'll tell you, the audience, I noticed it was noticeable that everyone was paying a lot of attention when they hear about a failure. And it's kind of like when you're driving on the road and you see a car wreck, and, if someone's like driving smoothly, everything's going great, who cares? But the car wreck, oh, that's kind of interesting. It's just human nature.
Right.
But people were interested. But I'll tell you, after that conference, people came up to me and said, hey, that really resonated with me. And because I went through this or that. And as I've gone through life, I realized that a lot of people have gone through different stuff. And it's very hard to realize, what they've been through. You're walking on the street, you pass people, and there's always a part of everybody that says, God, everybody else has it easy, and I'm the one that's struggling with this stuff. It's not the case. Everybody's struggling or has struggled at some point. And how you triumph those struggles, how you persevere is probably the best word through those, really can help define and empower you to, or for me, it certainly has helped empower me going forward. But the lessons that have been learned from failure are absolutely invaluable. So I guess to anybody who's struggling or has struggled, don't see that as a negative. See that as a positive, and the fact that you persevered and you keep going, because that's what really makes the true successes. There's so many successful entrepreneurs that you look at, and if you go back far enough, you're going to find the point at which they had a significant failure, and they learned from that and moved on.
I'm gonna let that be the last word. So tell them the website again.
preREO.com.
All right, we're gonna put it in the show notes. George, thanks so much for your time today. And this is fascinating. So we're gonna have you back, because there's a bunch of stuff I didn't for time purposes, I didn't even talk about that. I wanted to go, and my mind was racing while we were talking. Like, all right, no, let me stay focused. We're on a good path. Let me just get this out. And but there's some other stuff. But so George, I appreciate you so much. Thanks for coming on and sharing your wisdom, and a tremendous opportunity with my listeners on the Practical Wealth Show. And you have a great day. Everybody go out there and be prosperous.